Welcome, Dr. Tan, to our presentation of macroeconomic. Our group is Group 7, and we're going to talk about public debt. And here's the table of content.
Public debt has always been a controversial topic in the economy. Many people believe that the high public debt is dangerous and will slow down economic growth. However, many economists argue that the public debt is not necessarily bad, or as long as it's used in the right way. According to the IMF, what's really matter is not only how much government borrow, but how effectively that money is spent. Therefore, public debt is neither completely not nor completely bad. Its impact depends on the economic and how well the government manages it. Public debt simply refers to total amounts of money that government owed to both domestic and foreign planners. Its many ways through government bond and public loans. Government use public debt in invest infrastructure and support the economy during recession and establish spend over time. However, if that grew faster than the economy, it can lead to higher interest costs and financial pressure.
On this slide, I will explain why public debt can actually create positive economic effect, especially through productive investment. Public debt can be very beneficial when it is used for productive investment. When a government's fiscal capacity is limited, borrowing becomes the only way to finance long-term projects like infrastructure, education, or energy. In developing countries where private capital is often unwilling to invest, public debt fills the investment gap. This investment creates strong spillover effect. It means they raise productivity and reduce costs across the economy. In the solo model, when productivity increases, potential GDP rise even without more labor or capital, so public debt becomes a key driver of long-term growth. Public debt also plays an important role in lowering production costs. When governments borrow, they can stabilize input price, subsidize essential material, and support transportation. This immediately helps firms reduce their marginal cost of product, as shown in the graph. When input costs decrease, the MC curve shifts downward, meaning firms can produce more at a lower cost. This leads to lower price for customers, higher demand, and greater national output. Additionally, public debt finance R&D and technological upgrade, helping firms adapt and stay competitive during industrial transformation. During recession, government revenue fund welfare while spending rise. Public debt becomes essential because it allows government to keep the economy running when private demand collapses. By borrowing, the state can maintain public service, support households, and prevent a deeper recession. Next, public debt also helps government seize development opportunities. Breakthrough in AI, green energy, or supply chain shift often appear in short windows. If government wait for tax revenue, they will miss this opportunity. Borrowing provides the finance flexibility to invest immediately, allowing the country to build long-term competitiveness.
During the war, the US public debt fell from 106% in the 1946 to 23% in fiscal year in the 1974. This fall was often attributed to economic growth. There are some factors that can be illustrated. Firstly, the post-war period saw a rapid economic growth, rising from the 42% in the 1941 to the 106% in the 1946. It fell and reached 3% in the 1974. The debt ratio has risen in most years and reached 102% in the 20 and 22. Another factor is interest rates after World War II was extremely low, combined with GDP growing rapidly. Thus, the debt ratio fell from 106% in 1946 to 60% in 1955, demonstrating that high debt can remain unstable. The last one is tax capacity. Tax revenue increased from the 14% of GDP in the 1940s to about 20% in the 1950s. This brought the government stable revenue to pay debt with lower interest rate. As a result, despite experiencing 106% in GDP in the 1946, the US could lower it by 60% in the 1995.
So now we discuss the negative impacts of public debt. So one major concern is that the rising public debt puts upward pressures on the interest rate. Research shows that when the debt to GDP ratio rises by 1 percentage point, long-term interest rate increase by about 3 or 5 basis points. As debt grows, borrowing becomes more expensive across the economy. This happened because the higher government borrowing increases the demand for loanable funds. The government competes with private firms for the same pool of money, pushing the real interest rate up and making the private investment more costly. Over time, this reduces the capital, lowers productivity, and slow long-term growth. And this we call the crying out effect. Rising public debt also raises concern about inflation. If governments struggle to repay debt or if spending increases suddenly, especially during recessions, demands can rise faster than supply. And when supply cannot keep up, prices increase. Furthermore, investors who expect future inflation demand higher risk premium bonds, reinforcing the upward trends in the interest rate. Finally, higher public debt can lead to government to increase taxes. While taxes is essential for stabilizing borrowing, higher tax burden and inflation itself, often called a silent tax, which will reduce the household purchasing power. As prices increase, consumers shift from spending to saving, which lowers the overall consumption and tax revenue. This makes it even harder for governments to address the debt problem and can further slow the economic growth.
Hi, my name is Job, and this is my part on the negative effect of public debt. High level of government debt limit a country's ability to respond to future economic shock, and the UK experience during COVID-19 showed this clearly. In 2021 and 2022, the UK sharply increased borrowing to finance household support, business allowance, and recovery programs. This policy were effective in preventing long-term damage, but it caused an unusually large rise in government debt. A major issue is how this debt reacts to interest rate changes. The UK is especially vulnerable because much of its debt have short maturities and a large portion is index-linked. This means debt servicing costs rise quickly when interest rates rise. According to Office for Budgeting Responsibility, estimate a 1% point increase in short-term rate would add £8.1 billion in 2024 to 2025 and £7.8 billion in 2025 to 2026 and over £27 billion in 5 years. The ONS also report that interest payments have tripled and reached historic height related to government income. The rising cost of servicing debt also worsen inequality when more of the budgets go to interest payment. The government must choose between raising taxes or cutting welfare, both of which disproportionately affect low and middle income households. At the same time, bondholders, who are generally wealthier, receive over £111 billion a year in interest. Research also showed that increasing public debt can contribute to growing labor income inequality, as government often avoid taxing wealth and instead reducing progressive redistribution. Chesapeake research note that the problem isn't debt itself, but the loss of physical space, especially when structural pressure like aging populations, the energy transition, and defense spending continue to rise. Overall, high public debt reduces physical flexibility, increases vulnerability to interest rate shock, and heightens inequalities. This limits the government capacity to support the economy effectively during future crises.
The Greek case demonstrates how high public debt, when combined with structural weaknesses and poor fiscal credibility, can severely undermine economic stability and lead to long-lasting social and financial consequences. In the 2010, Greece not only suffered from less fiscal deficits, but also widespread invasion in the tax and administrative efficiency. The position of the Greek economy became riskier when the global financial crisis boomed in 2008. Some international investors reassessed the risk of lending to countries with high level of debt. The debt increased in 2009 due to the higher than expected government deficit and higher debt service costs, causing government bond yield to climb to a negative level. In this difficult circumstance, the government offered permanent and temporary austerity measures. Compliant reforms and austerity measures reduced the baseline of deficit from the 30.6 billion in the 2009 to 5.7 billion in the 2013, while the debt ratio would stabilize at 120% in the 2010 and 2011 and declined in the 2012 and 2013. The economy entered a prolonged recession, unemployment soared, and public welfare deteriorated.
To ensure that public debt remains sustainable, two key solutions are sound macro-fiscal policy and strong governance. First, on the macro side, government needs to maintain fiscal discipline. This includes setting debt ceiling, strengthening the tax system, and apply counter-cycle fiscal policy. When public spending is transparent and efficient, public debt can actually have a stabilized economic growth instead of becoming a long-term burden. Second, strong government is quality important. Government must ensure transparency by fully reporting their debt, interest payment, and fiscal risks. Strong institutions like independent audit agency and parliamentary oversight can also prevent wasteful or political motivated spending. In addition, public borrowings should focus on the productive sector like infrastructure, education, healthcare, and digital transformation. Germany is a good example of a balanced economy is use strong fiscal growth and a government to control a public debt. Meanwhile, Vietnam represents an emergency economic that have improved debt management by directing borrowing into transport infrastructure and digital development. These examples show that the public debt not always problem if it's managed quickly.
So to conclude, we will answer the previous question at the beginning of the presentation. So public debt is not always a problem, and by using effective regulation, we can minimize the risk and enhance the pros of using public debt.
That is the end of our presentation. Thank you for listening.